Are all these worries about private credit markets just hysteria? Apollo Global Management CEO Marc Rowan seems to think so. He recently said that everyone had lost their minds about private credit losses, and he even called the press hysterical. But I've been following private credit for years, and I don't think he's entirely right. For some borrowers, next year things are going to get much trickier, and this chart here helps explain why. Since private credit is, well, private, we don't have a lot of hard data, but the numbers we do have show that the outlook isn't great, and in fact is about to get worse. When private equity funds want to buy a company, they often use private, junk-rated loans. These are very similar to the leveraged loans that banks originate and sell to investors. Now, this is slightly different from what Marc Rowan was talking about, but it's still a brewing problem. Default rates among these borrowers have climbed steadily since late 2022. The trailing 12-month default rate hit 1.3% this summer, which is up from just under 0.5% in autumn 2022. But that's only part of the story. There's also selective defaults, where borrowers change the terms on their debts to give themselves a bit more breathing room. Now, if we add those into the data, the blue line on that chart, the selective default rate is much higher. Companies that selectively default aren't making enough money to cover their debts. Their lenders haven't lost real money yet, but the borrowers are definitely in trouble. And more businesses seem to be heading in that direction. About 15% of junk-rated borrowers aren't making enough operating profit to cover their interest costs. Many will likely face some kind of reckoning next year, and that will likely mean losses for their lenders. All of that makes fears about the private credit market undeniably more real.